Most people assume the fastest way to grow a trading account is to risk big when you feel sure about a trade. Bigger position, bigger payoff. That's the math everyone runs in their head. It's intuitive. It's also, statistically, the single fastest way to end a trading career. Here's what almost nobody tells beginners. The traders who actually last aren't the ones swinging for 10% per trade. They're the ones risking a fraction of a percent, 0.5%, maybe 1%. Not because they lack conviction, because they've done the math on what one bad week actually costs, and they'd rather still be in the game a year from now than be right once and gone. Jesse Livermore made the equivalent of $1.5 billion shorting the 1929 crash. 5 years later, he was bankrupt. Not because his analysis stopped working, because his position sizing eventually caught up with him, the way it catches up with almost everyone who trades big long enough. By the end of this video, you'll understand exactly why small, boring position sizes consistently outperform aggressive ones over time, and why the traders managing real institutional money size smaller than most retail traders ever would. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Let's start with the number that should terrify every trader long before any chart pattern does. If your account drops 50%, you don't need a 50% gain to get back to even. You need 100% gain. Double what's left, just to arrive back where you started, before the loss ever happened. Say that out loud and it sounds almost like a trick question, the kind of thing that shouldn't be true, but the arithmetic doesn't care how unfair it feels. Lose half your money, and you need to make all of it back and then some, just to break even. This is not a philosophical point about risk. It is not a motivational slogan about discipline. It is pure, cold math, and it is the single most underappreciated fact in all of trading, because almost nobody sits down and actually runs the numbers before they blow through their risk limits for the first time. Here's how it plays out in practice. A trader decides he has conviction on a setup, so he risks 10% of his account instead of the 1 or 2% every risk manager on earth would tell him to use. It feels justified in the moment. He's done his analysis. He's confident. 10% feels like an aggressive but reasonable bet on himself. Then the trade goes against him, which happens to everyone eventually, no matter how good the setup looked. He's down 10%. Not catastrophic, he tells himself. Then it happens again, and again. 5 losses in a row is not some rare, unlucky event in trading. It is a completely normal statistical occurrence that shows up in the track record of even the best traders alive. 5 losses at 10% each doesn't just cost 50% in a straight line, because each loss is calculated against a smaller and smaller account. But even in the more forgiving version of the math, that trader is now looking at a balance that has been cut roughly in half, and the moment that happens, something fundamental shifts. He is no longer playing the same game he started the week playing. Compare that to the trader risking 1% per trade. Same 5-loss streak. Same bad week. Same unlucky run of setups that simply didn't work out. Because sometimes they don't. And that has nothing to do with skill. That trader is down about 5%. 5%. He's annoyed, sure. Maybe he goes back and reviews his entries to see if there was something he missed. But he is not staring at a decimated account. He is not recalculating his entire financial future. He opens his laptop the next morning and does the exact same thing he did the morning before. He looks for the next good setup. That's the entire difference, and it has nothing to do with who is the better analyst. Both traders might have identical skill at reading a chart. The only variable that determined whether one of them is playing offense and the other is playing a desperate game of catch-up was the size of the bet, not the quality of the idea behind it. This is what almost nobody explains to beginners, and it's worth sitting with for a second, because it inverts the entire way most people think about risk. The damage from a large loss isn't linear. It's not like losing 10% twice equals losing 20% once. The hole gets deeper and steeper the further down you go, and the climb back out gets proportionally harder with every step. A trader down 20% needs a 25% gain to recover. A trader down 50% needs a 100% gain. A trader down 80%, and this happens more often than people admit, needs a 400% gain just to get back to zero. At a certain point on that curve, recovery stops being difficult, and starts being almost mathematically impossible within any reasonable amount of time. This is the trap. Not that big losses hurt. Everyone already knows big losses hurt. The trap is that big losses hurt exponentially more than they appear to in the moment they happen, because the true cost isn't visible until you try to climb back out and discover the ladder got longer every rung you fell. So here's the practical reframe, and it's less exciting than most trading advice, but infinitely more useful. Before you ever open a position, the question isn't, how much could I make on this trade? The question is, what does my account look like if I'm wrong? And how many times in a row can I be wrong before I've done irreversible damage? If the answer to that second question is anywhere close to, a handful of normal losses could put me in a hole I can't dig out of, the position is too large, full stop, regardless of how good the setup looks on the chart. Capping risk at 1 to 2% per trade isn't playing it safe in the way people mean when they say that dismissively. It's simply refusing to let a normal, expected losing streak turn into a mathematical catastrophe. Because losing streaks aren't a bug in trading, they're a guaranteed feature of it. The only real question is whether you sized yourself to survive one. Now let's talk about a man who made more money in a single trade than most people will see across their entire working lives, and still ended up broke, because he never learned this lesson, or he learned it and forgot it the moment he started believing his own reputation. Jesse Livermore became a legend in 1929. While the rest of the country watched their savings evaporate, he shorted the crash and walked away with the equivalent of roughly $1.5 billion in today's money. Think about what that actually means. He wasn't just right, he was spectacularly, historically right, at a scale almost no trader before or since has matched. Newspapers wrote about him. Other traders studied his every move like it contained some hidden formula. He was, by any measure that existed at the time, the single greatest trader in the world. 5 years later, he declared bankruptcy. Sit with that gap for a second, because it's almost impossible to reconcile at first glance. How does someone go from effectively a billionaire to broke in half a decade? It wasn't that the market suddenly turned against him and he never traded again. It's that something happened inside his own head after that legendary win. Something that happens to traders at every single level of this profession if they're not deliberately guarding against it. He got sloppy with his position sizing. He started taking positions that were dramatically larger than anything his risk framework should have allowed, because a small, quiet, dangerous belief had crept in, that he had somehow become different from other traders, that the rules that applied to everyone else didn't quite apply to him anymore, because he had already proven, spectacularly, that he knew something other people didn't. He had confused a winning streak, even an extraordinary one, with a permanent state of invincibility. The market does not care about your track record. It does not remember your best trade. It has no memory of the $1.5 billion you made 5 years ago, and it will happily take all of it back, along with everything you had before, if you keep sizing your positions like a man who believes he cannot lose. That's exactly what happened to Livermore. Not once, but repeatedly throughout his life, he rebuilt fortunes and lost them again, each time undone by the same underlying failure. Before he died, he wrote something that should be printed on the wall of every trading desk on earth. My life has been a failure. Read that again. The man who once controlled enough capital to move entire markets, who made more in a single trade than most people accumulate across a lifetime of work, died believing his life had been a failure because he could never stop betting too big for too long. Here's why this story matters so much more than most cautionary trading tales you've heard. It wasn't a strategy problem. Livermore could read markets better than almost anyone alive at the time. It wasn't an analysis problem. His calls were, by and large, remarkably sharp. It was a survival problem, and survival problems don't care how brilliant your analysis is. Brilliant analysis without a hard ceiling on position size doesn't protect you from catastrophe. It just builds you a bigger, more impressive platform to fall from. The lesson here isn't, don't be confident. Confidence in a well-researched setup is fine. The lesson is that your confidence, no matter how justified it feels in the moment, should never be allowed to override a mechanical, pre-decided limit on how much of your account is on the line. Decouple the two completely. How good a setup looks and how much you risk on it should never be the same decision. because the moment they become linked, you're one exceptional feeling trade away from becoming the next version of this story. Which brings us to something almost nobody talks about, honestly, because it makes trading sound less like a skill and more like an addiction pattern, and that's an uncomfortable thing to admit about a profession people romanticize constantly. When you risk big and win, your brain floods with dopamine. It feels incredible. For a moment, you feel like you've cracked something other people haven't. You feel sharp, invincible, like the market just confirmed what you always suspected about your own ability. And naturally, you want that feeling again, so on the next trade, you size up even further. Why wouldn't you? You just proved, at least to yourself, that you could do it. Then you lose. And here's the part that isn't just a saying people repeat to sound wise, it's actual, measurable neuroscience. The psychological pain of losing money is roughly twice as intense as the pleasure of winning an equivalent amount, not slightly worse, roughly double. So when a large position goes against you, the emotional hit isn't proportional to the size of the win that would have made you happy. It's disproportionately, brutally worse. And in that state, with your nervous system screaming at you that something needs to be fixed immediately, rational thought becomes almost impossible. You can't sit patiently and wait for the next clean setup. Every fiber of your attention is fixated on one goal: get back to even, right now, by any means necessary. So you size up again, trying to recover the loss in 1 or 2 trades instead of the dozens it would take to rebuild slowly and sensibly. This is revenge trading, and it is not a fringe behavior that only undisciplined amateurs fall into. It is one of the single most common ways trading accounts actually die, not from bad strategy, not from poor market analysis, from a nervous system in full emotional override, driven there by a position size that was too large to begin with. If you've ever felt that exact pull, the urge to size up the second a loss lands, that's precisely the window the revenge trade kill switch inside the complete trading system was built for, a short protocol for the 5 most dangerous minutes of your trading day. It's less a course and more a reference to run through before your next trade filters through rules, instead of that feeling. Now, before we go further into exactly how this compounds during real market chaos, this is the moment to hit subscribe and turn on notifications if any of this is landing for you, because the next section covers something that happened during one of the most violent stretches of market volatility in modern history, and it's the part of this framework that separates traders who survived it from traders who got wiped out in a matter of days, sometimes hours. Because here's what safe position sizing actually protects you from, and it's bigger than just avoiding a bad month. When you're only risking 1% per trade, your emotional response gets muted almost automatically. A loss stings a little. It doesn't devastate you. You're not spiraling, not lying awake recalculating your entire financial life at 2 in the morning. And on the flip side, a win feels good, but it doesn't send you into a dopamine-fueled state where you start sizing up recklessly on the next trade, chasing that feeling instead of the setup. You stay level, you stay rational, and in a profession where the market genuinely does not care how you feel, but your feelings determine literally every decision you make with your own hands, staying rational isn't a nice to have. It's the entire game. Picture 2 traders who started at the exact same time with the exact same amount of capital, $25,000 each, studying the same material, watching the same channels, practicing on the same simulators. On paper, at the start, they were functionally identical. Trader A wanted results fast. He was tired of his day job, tired of the grind, and he saw trading as his exit ramp. So he sized aggressively, risking around 5% per trade, because he needed bigger wins to justify the hours he was pouring into this. Within 6 months, his account had dropped to about $8,400. One particularly brutal month nearly wiped him out entirely. He wasn't sleeping properly. He was stressed constantly. People close to him noticed he was on edge all the time, checking his phone compulsively, carrying the market around with him into every part of his day. Trader B took the boring road, risked about 1.5% per trade. Trader A actually mocked this at the time, calling it boring money, insisting he'd never get anywhere trading that small. Trader B didn't care. He had a day job he didn't hate, so he wasn't in a rush, and he focused purely on staying consistent. 6 months in, his account had grown to a bit over $31,000. Nothing dramatic happened along the way. No screenshot-worthy massive wins. No viral trading day. Just quiet, steady, almost forgettable growth. And here's what actually mattered more than the number. He slept fine every single night. His worst drawdown across the entire 6 months was around 11%. A rough couple of weeks, but nothing that kept him up staring at the ceiling. Trader A's account got cut in half. Twice. His relationships suffered. He was short-tempered with the people who loved him. A year later, he quit entirely, telling everyone that trading was too risky, probably a scam, rigged against people like him. He walked away convinced the game itself was broken. Trader B is still trading 5 years later, sitting on a 6-figure account, and he eventually left his day job, but only once his trading income had become large enough that leaving felt safe rather than desperate. Same market, same starting capital, same access to information. The only variable that diverged was position size, and it produced 2 completely different lives, not just 2 different account balances. That divergence becomes even sharper when the market itself goes insane. Which brings us to March of 2020. COVID hit, and markets lost their minds almost overnight. Stocks were moving 20, 30, sometimes 40% in a single session. Circuit breakers were triggering repeatedly. The VIX, the market's fear gauge, spiked to levels not seen since 2008. If you were sizing at 10% per trade, and you happened to be positioned on the wrong side of one of those violent moves, you could lose 30 or 40% of your entire account in a matter of hours. Not your position, your entire account. Because stops weren't executing where they were supposed to. Slippage during that period was severe, and volatility that intense doesn't politely respect your risk plan. It just eats through it. Traders who were risking 1% per trade absolutely took hits too during that stretch. Nobody escaped that period unscathed. But a 30% adverse move against a 1% position translates to roughly a 3% account hit. Painful, certainly. Frustrating, absolutely. But still standing. Still in the game. And here's the part that makes this whole episode so instructive. That crash lasted about a month, maybe 6 weeks, before markets started recovering. And when they recovered fast and hard. Traders who survived that initial drop with their capital intact got to participate in one of the sharpest recoveries in market history. Some of them had the best months of their entire trading careers on the way back up. Meanwhile, the aggressively sized traders were already out, sitting on the sidelines with blown or badly damaged accounts, watching everyone else capitalize on exactly the kind of opportunity they'd been chasing all along. Except now, they didn't have the capital to participate in it. Volatility doesn't care how confident you were going in. It doesn't care how sound your analysis was. It simply eats oversized positions, and it does not ask for permission first. So here's a question worth sitting with. What do actual professional traders, the ones managing millions or billions of other people's money, risk per position? You'd think, given the resources available to them, the research teams, the real-time data feeds, the decades of institutional experience, they'd be sizing aggressively, right? The opposite is true. Most professional desks risk somewhere between 0.5% and 2% per position. The most elite hedge funds and proprietary trading firms, the ones with track records most retail traders would kill for, sometimes go as low as 0.25% on individual positions. Let that actually sink in. These are institutions with entire teams of analysts, sophisticated algorithms, access to information retail traders will never see in their lifetime, and they are still playing it, by retail standards, almost absurdly conservative. Why would that be, if aggressive sizing were actually the path to faster growth? Because they've internalized something retail traders consistently refuse to accept. Staying in the game is the prerequisite for everything else. Survival isn't a defensive afterthought bolted onto a growth strategy. It is the growth strategy. You cannot compound returns from an account that no longer exists. Paul Tudor Jones, a trader who has been consistently excellent since the 1980s, has a rule that sounds almost too simple to matter. If a losing position is making you uncomfortable, the solution is to get out. That advice only actually works if your positions aren't terrifying to begin with. When you're risking 10% per trade, Every single position is terrifying by design, which means you can't cut losses cleanly and quickly, because each cut feels catastrophic. So instead of exiting cleanly, you hold, you hope. And that's exactly how small, manageable losses quietly metastasize into account-ending disasters. Retail traders treat small position sizing as something for people who are scared of the market. Professionals treat it as the single non-negotiable precondition for staying employed long enough to compound anything at all. There's one more layer to this that almost never gets discussed, and it might be the most quietly devastating cost of oversized losses, because it isn't measured in dollars at all. It's measured in time. When you take a massive loss, you're not just losing capital. You're losing something you can never buy back at any price, no matter how good your trading gets afterward. Say you lose half your account. Even if you're genuinely skilled, even if your strategy is sound, and your win rate afterward is strong, clawing your way back to where you started doesn't take weeks. It can take years. Actual years of your life spent simply trying to return to a number you'd already reached once before. Compare that to losing 10% of an account. That's recoverable in months, sometimes weeks, through completely routine, stress-free trading. But the deeper cost sits underneath the recovery timeline itself. Every single month you spend clawing back from a massive loss is a month where your capital isn't compounding forward. It's a month of pure opportunity cost. Dead time where your money should have been working and instead is just trying to get back to zero. If a blown account takes you 2 years to rebuild, you haven't just lost 2 years of time in some abstract sense. You've lost 2 years of compound growth that can never be recovered. 2 years of market opportunities that came and went while you were digging out of a hole. 2 years where that capital could have been building real, lasting wealth instead of just crawling back toward a starting line you'd already crossed once. Aggressive trading doesn't just risk your money. It quietly steals the one resource wealth building actually depends on more than any other, which is time spent compounding, not time spent recovering. And most people don't have unlimited decades to keep restarting from scratch every time an oversized bet goes wrong. Now, here's the objection that always comes up at this point, and it's worth addressing directly, because it's the most seductive argument for aggressive sizing that exists. What about the massive winners? What if a trade goes 10-1 in your favor? Isn't that the entire point of trading? Catching the runner that changes everything? Risk 1% and catch a 10-1 winner, and you've made 10% on your account in a single trade. That's a great outcome. But risk 10% on that same setup, and suddenly you've doubled your entire account on one trade. That sounds dramatically better on paper, and it's exactly the math aggressive traders point to when they justify oversized positions. Except here's the reality nobody wants to hear. You will never make it to that trade. The losses along the way, and there will always be losses along the way, even for the best traders in the world, will have already destroyed your account long before that 10-1 setup ever shows up. To even get the opportunity to catch a genuinely exceptional trade, you typically need to sit through hundreds, sometimes thousands, of ordinary trades first. Somewhere in that stretch, you're going to hit a losing streak, because losing streaks are simply part of the process, not a sign that something's gone wrong. If you're sizing at 10% per trade, a completely normal losing streak ends your account before that big winner ever has a chance to arrive. Small, consistent sizing is precisely what keeps you in the game long enough to actually be there when the runner shows up, because those trades genuinely do happen, but only for traders who are still solvent when they do. The aggressive trader isn't skipping the line to get to the big win faster. They're mathematically eliminating themselves from the game before the big win was ever within reach. There's a version of this that plays out in real time, over and over, in trading communities everywhere, and it's worth walking through because it compresses the entire arc into a matter of weeks instead of years. A trader starts with $50,000. He's actually good, genuinely skilled at spotting setups, and for about 2 months, everything works. His account climbs to $71,000. And somewhere in that stretch, something shifts. He starts talking differently about his own ability, starts posting screenshots of daily profit and loss, starts sizing up to 8% per trade because, in his own words, when you know, you know. Then the market does what it eventually does to everyone. It hands him a rough patch. 5 losses in a row. Nothing unusual. It happens to every trader eventually. His account drops to $45,000. And this is where it turns genuinely ugly. Instead of stepping back, he panics, starts talking openly about needing to make it back, and pushes his sizing up to 15% per trade to recover faster, because in his mind, he can't afford to grind it back slowly anymore. 3 more losses. Account drops to $26,000. He's desperate now, completely untethered from any strategy, taking trades that don't even match his own system anymore, sizing 25% per trade on pure emotion, chasing a feeling rather than a setup. Within 6 weeks of hitting his peak at $71,000, his account is under $3,000. His analysis never got worse. His ability to spot a setup was never the problem. Position size and the emotional spiral that oversized losses trigger undid every bit of genuine skill he actually had. That's the pattern underneath almost every version of this story. Whether it's a legendary trader from the 1920s or someone in a Discord server last year. The chart reading was never really the weak link. The sizing was. And once you actually internalize the math behind the recovery trap, the neuroscience behind revenge trading, and the way volatility punishes oversized bets specifically, it becomes almost impossible to look at aggressive position sizing the same way again. But knowing all of this intellectually, and actually behaving differently the moment a high-conviction setup appears on your screen, are two completely different things. And that gap is exactly where the next part of this conversation begins. You came into this expecting a video about risk tolerance, about how much conviction it takes to size up, and how playing it safe is just what cautious traders tell themselves to feel okay about growing slowly. That was never actually the subject. What you understand now is that position size isn't a confidence question. It's a survival question. And those are two completely different games. A 50% loss doesn't need a 50% gain to fix. It needs a 100% gain, which is why the math of ruin punishes big losses so much harder than it rewards big wins. Jesse Livermore didn't lose everything because his analysis failed. He lost it because no amount of skill protects you once your position size removes your margin for error. The revenge trade that follows a big loss isn't a discipline problem, it's a nervous system, doing exactly what a nervous system does when the pain of losing hits twice as hard as the pleasure of winning. And the traders managing real institutional capital, the ones with every advantage retail traders don't have, still size down to less than 2%, because they learned a long time ago that staying in the game is the strategy, not a hedge against one. None of this was ever really about being aggressive versus being cautious. It was about which version of you is still trading a year from now. The one who was right once and gone, or the one who's still there when the good setup finally shows up. That's worth sitting with before you place your next trade.